Within the construction and engineering space, railways have been in a sweet spot thanks to the growing revenue visibility because of a strong order book. Let's do a three-point analysis to see if railway stocks could be good long-term bets for investors. 1. A quantum jump in investment and orders. Well, the government has stepped up its capital investment on railways from about 1 lakh crore rupees in fiscal year 2016 to 1.5 lakh crore rupees in fiscal year 2019. Dedicated freight corridors, capacity augmentations and high-speed rail stations, also development and metro and suburban railways and also other avenues have opened up a huge opportunity. IRCON was sitting on an order book of over 17,000 crore rupees in the fiscal year 2016, which now stands at over 32,000 crore rupees, which is almost 7 times the annual sales. Similarly, RITES, which is present in the railways and engineering space, has seen a spurt in the order book from 4,800 crore rupees in fiscal year 2017 to the current level of 6,000 crore rupees, which is 3 times the annual revenue. 2. Strong traction in execution. Well, helped by a robust order book which provides strong revenue visibility, both the companies have been growing at a fast pace. Now, RITES and IRCON are execution agencies that undertake orders from the government and the PSUs on a turnkey and consultancy basis. Now, RITES, for instance, over the last 4 quarters has delivered an average of 51% year-on-year growth in revenues. In H1 FY19, RITES has recorded a 66% year-on-year growth in revenues, and IRCON has also seen a growth of 32% year-on-year. More importantly, if you see, the managements of both these companies have remained upbeat about the execution, particularly in the second half of the current financial year, because of increased activity. Now, what's more, these companies have plenty of cash in the books and are gradually deploying the cash in the business or maybe returning it back to their shareholders in the form of a dividend. Now, this will gradually support growth and rectify also their return ratios going forward. 3. Should investors look to add these stocks to their portfolio? Well, in terms of valuations, both the companies are trading at about 6 to 8 times their 1-year forward estimated earnings, which are quite attractive, particularly in the light of a current dividend yield of close to 4 to 5%. Moreover, the valuation also should be looked at from the perspective of a huge growth opportunity which is seen in the long run and their strong positioning in this space as well. Now, both the companies have a solid balance sheet and also generate consistent free cash flows from the operations, which can easily allow them to sustainably grow over the next few years at a reasonable 15 to 20% growth rate.